Hi everyone, welcome to 3.5. This is another area that students find quite tricky. It's another one of the financial kind of calculation sections. A lot of this links to some of the stuff that we did in theme 2. So if you've watched the 2.3 video on profit and liquidity, some of this first part is going to be fairly, not necessarily repetitive, but it's going to be going over stuff you should hopefully be aware of. 3.5.1 is about the interpretation of financial statements and the calculations you can do from them. I'm going to focus on the statements in 3.5.1. When we do 3.5.2 ratio analysis, I'm going to focus on the calculations. Most of the calculations are already ones we've covered in the 2.3 video. However, there are some new ones that are in the theme 3 that aren't in theme 2. So I'm going to include those as well. So the first statement is the statement of comprehensive income. This one shows the revenue and the costs that a business has over the course of a period of time. Usually this is going to be over the course of a year. So in terms of our chart looks a little bit like this. So we've got our revenue, we've got our cost of sales, we've got our gross profit, we've got our fixed overheads, we've got our operating profit, we've got our financing costs, we've got our net profit. And so as we go through our costs and remove different costs, we get different types of profit. And so the first thing we can do is calculate the gross, operating, and net profit. So it goes down the table. Revenue minus cost of sales is gross profit. And that's just the profit we've made after just taking off our cost of sales, our kind of direct costs. We then take away our fixed overheads, so gross profit minus fixed overheads is our operating profit, and that's our profit after taking away our cost of sales and our fixed overheads, our indirect costs. We can then take away our financing costs, so interest and tax and what have you, and that will give us our net profit. So in this situation, our revenue is 200,000. These are the same figures we used in the Theme 2 video. Our gross profit is 125,000. That means of the revenue of 200,000, we kept 125 as gross profit. We kept 75,000 as operating profit, and overall, over the course of the year, we made £70,000 in net profit. The second statement is the statement of financial position, and this shows the value of a business's assets and liabilities on a specific date. So this is a simplified version, but it would always look like this. Just might not have all of the bits in. We've got our non-current assets, our current assets. So these are our long-term and short-term assets. So our long-term assets will be things like buildings, machinery, vehicles, equipment, things that we are going to have and we're going to expect to have for a long period of time. We're not likely to turn them into cash within the next year. The word non-current means not within the next 12 months. Our current assets either are already cash, so cash in the bank, or they might be things that hopefully or should turn into cash within the next 12 months. So stock, inventories, or receivables, money we're owed by our customers. That stuff should become cash within the next 12 months. Not all of it will. We'll talk about that in a little bit. We've also got our liabilities. So our liabilities are our debts. So we've got current and non-current liabilities. Our current liabilities are our short-term debts. So this is like money we owe to suppliers, short-term loans, tax. And our non-current liabilities are our long-term loans. So this could be mortgages, things we owe that we're going to pay off over a year. So you can see there, our non-current assets were worth 800,000, current assets 160, current liabilities 110, but obviously that's a liability, so it's a negative. And then non-current liabilities are £500,000. Usually the non-current liabilities have paid for the non-current assets. But again, if you want more detail on that, I would recommend having a look at the Theme 2.3 video. We've then got our net assets and liabilities, which is our total assets minus total liabilities. And then at the bottom, we've got our total equity, which is the total investment in the business from the owners. And that comes from share capital and retained profit. And we are going to talk about that one again. So that's kind of those are the two financial statements. You need to understand what each of those terms mean. The numbers aren't really that important. You need them, of course, for the calculation, but the most important thing is that you know what all those terms mean. That allows us to do this ratio analysis. So let's look at the ones we already know. So we already know our gross profit margin, net profit margin, operating profit margin. That's just gross profit over revenue times 100, operating profit over revenue times 100, net profit over revenue times 100. They are Theme 2 calculations, so hopefully they're fairly straightforward. We also have our current ratio and our asset test ratio. So our current ratio is our current assets over our current liabilities equals x to 1. That basically shows us how many assets, current assets, we've got for every one current liability. We ideally want more current assets than current liabilities because that means we've got more short-term cash coming in than we have going out. So that suggests that we'll be able to pay our bills. The asset test ratio is the same, but we take away a stock because stock isn't a very reliable asset. We might not sell stock for a variety of reasons. It could be that it becomes perishable if it's a food product. It could be that it becomes obsolete if it's a technology product. It could become that it's out of fashion if it's a fashion-related product. So those calculations we should hopefully be aware of from theme 2.3, but there are some new ones we need to be aware of. And in order to understand these, we need to understand the concept of capital employed, because we're going to use that in both of these other two equations. Capital employed is the only, one of these calculations, I should say, is the only one where you need both tables. So the first one that we're going to have a look at after we've done capital employed, you need information from both the statement of comprehensive income and the statement of financial position. But before we do that, we need to know what capital employed actually means. So capital employed is all of the available finance that a business has, and that's going to come from two places. That's going to come from our internal finance, and our internal finance is the money that we've been given by our shareholders. So that's going to be our share capital raised and our retained profit, or as we know it from our statement of financial position, our total equity. So our total equity basically is just our internal finance. But a business can also get external finance. And that external finance is usually in the form of a loan. And we know what a loan is called on our statement of financial position. It's called a non-current liability. So our external finance is our long-term loans, our non-current liabilities. So the calculation for capital employed is just those two added together. Total equity plus non-current liabilities equals capital employed. So you can learn these next two formulas as over capital employed, or you can learn them as over total equity and non-current liabilities. I just think if you're going to understand what these words mean, then you may as well understand what capital employed is. Internal and external finance added together. Total equity plus non-current liabilities. So these are the two formulas. The first is return on capital employed. Quite on the nose that it needs capital employed. Literally, it's about the return on capital employed. And it's about how much of our capital employed, how much of the money that we've invested in the business, how much of the money that's been available for the business to use, have we returned as operating profit? Obviously, the higher this is, the better. If it's negative, then that means we haven't made an operating profit. So the higher this is, the more profit we've made. So that's ROAS. Quite often you'll see that just labeled as ROAS. But that is probably, for many businesses, the most important measure because it assesses basically how well you've used your finance, how well you've used your money. The second is our gearing ratio. And our gearing ratio assesses how much of our finance has come from debt or come from liabilities. So for this one, we're just going to do our non-current liabilities divided by our capital employed, which means, yes, that means you're going to do non-current liabilities divided by non-current liabilities plus total equity. But that's what it's supposed to show. How much of that capital employed is debt? There's no necessarily right or wrong answer for this. If the answer is quite a high percentage, that suggests that the business relies on loans. That's not really that much of a problem as long as they can pay them back. But it might mean that if interest rates go up quite significantly, that business might find that more difficult. If a business has a really low figure, then that just means that they're what we call low gearing, which means they don't really rely on loans to spend. They spend on quite a lot of retained profit. And so it's usually down to a preference as to which a business would prefer. But the key thing is that if you can pay them back, it's not a problem. So you could quite easily pause this video and calculate all of those formulas for the information that we've got on the table there. And I'm sure someone will do those calculations and chuck them all in one of the comments. And so you can check whether your answers are correct. I'm sure I can leave that to you guys to sort out. If you've got any questions about any of them, then let me know. I haven't done these calculations, by the way. I just made up the figures for this video. So I haven't done these to get answers, but I'm sure you guys can figure it out. You've got the formulas in front of you. You've got the numbers. They shouldn't be too difficult. The last part of 3.5 is human resources. And we've done human resources. Human resources came up in theme 1, in 1.4. But this is about how we measure our human resources and how we do this using how our competitiveness is in terms of numeric information. So there's a few different calculations we can do here. One is labor productivity. And this is effectively measuring how much output we get from each of our employees. And the formula here is the output per that time period divided by the number of inputs. So for example, if we were measuring the amount of cars produced and we had 3,000 employees, it would be the number of cars produced overall over the course of a year divided by the number of employees we had. And that would tell you how many cars each employee contributed to, basically, how much they produced. So that's labor productivity. The next is labor turnover, and this measures the percentage of staff who leave the business. This is a really good measure of motivation, but one thing that's worth bearing in mind is sometimes staff leave for totally valid reasons. Sometimes it's got nothing to do with whether you're motivating them well or not. Sometimes they're retiring. Sometimes they are, deciding to move house or change location or something like that. Or it could be due to sickness or anything like that as well. The calculation here is the number of staff leaving divided by the total number of staff employed. Sometimes they'll do an average number of staff employed if the business has grown in that period of time. So if they started with 50 and they ended up with 100, they might use 75, for example. You can also do this the other way around by doing labour retention, which is the number of staff that don't leave. So you can then judge that the other way. But again, the key thing here is to understand the reasons why staff are leaving. And also to bear in mind that, in some industries, you do have high labour turnover. McDonald's and fast food places typically have quite a high labour turnover because of the nature of their businesses. A lot of their workers are part-time workers who are maybe doing that alongside their studies. And so they understand they're going to have high labour turnover. The downside of this, of course, is if you've got high labour turnover, that means you're going to have to spend quite a lot of money on recruitment and selection and potentially training. It means you're going to have quite a lot of inconsistency. It's going to mean that it's going to be quite difficult to impose a kind of strong culture on the organization. So hopefully that helps understand some of those calculations. I would strongly recommend making sure you get some practice in. Again, have a look at the exam questions from the past in the exam question finder that you can see in the comments in the description here, and have a look at those and do some of those practice calculations. I think they're hopefully fairly straightforward, but making sure you practice those formula is really, really important. But make sure you don't just practice the formula in terms of doing the formula. Make sure you understand what the formula is telling you. If you get a return on capital employed of 10%, what does that actually mean? If you get an asset test ratio of 2-to-1, what does that actually mean? If you've got any questions, check them in the comments, and I will see you on the next video.